If you own silver, or if you've been watching it from the sidelines, what I'm about to share with you isn't speculation. It isn't hype. And it isn't designed to make you feel euphoric or terrified. It's something far more valuable: clarity. Because right now, in early 2026, silver sits at a crossroads. Not the kind you see in headlines or social media posts filled with rocket emojis. The kind that only reveals itself when you step back, look at the full picture, and ask the right questions. Why has silver remained stubbornly undervalued for years while other assets soared? What forces are quietly building beneath the surface? And most importantly, what should you do about it? I'm not here to tell you silver is going to the moon tomorrow. I'm here to help you understand what's happening, why it matters, and how to position yourself intelligently, whether you already own silver or you're considering your first purchase. This isn't about getting rich quick. It's about making informed decisions in an environment where most investors are driven by emotion, distraction, and incomplete information. Over the next 25 minutes, we're going to walk through the fundamentals driving silver's current position. We'll examine the psychology that causes investors to make costly mistakes. We'll look at what history teaches us about precious metals during periods of economic transition. And we'll discuss specific strategies for both current holders and prospective investors. By the end, you'll have a framework. Not a prediction, not a guarantee. A framework for thinking clearly about silver in the context of your broader financial life. So let's begin. Silver occupies a unique space in the world of assets. It's not quite like gold, though many investors lump them together, and it's not quite like copper or other industrial metals. Though silver shares some of their characteristics, this hybrid nature is both silver's greatest strength and the source of much confusion. Let me explain. Gold is primarily a monetary metal. Yes, it has industrial uses, but the overwhelming majority of gold demand comes from investment in jewelry, from people who view it as a store of value, a hedge against currency debasement, a form of insurance. Copper, on the other hand, is almost purely industrial. Its price moves with manufacturing activity, construction, and economic growth. Silver straddles both worlds. Roughly half of silver demand comes from industrial applications: solar panels, electronics, medical devices, water purification, batteries. These aren't luxury uses. They're essential components of modern technology and the energy transition the world is pursuing. The other half comes from investment demand in jewelry. People buy silver coins, bars, and ETFs as a store of value. They view it as precious, as real money, as a hedge. This dual nature creates volatility. When industrial demand surges, silver rises. When investment demand spikes during economic uncertainty, silver rises. When both happen simultaneously, silver can move dramatically. But here's what most investors miss. Silver moves more violently than gold in both directions. During the 2008 financial crisis, gold fell roughly 30% from peak to trough. Silver fell nearly 60%. During the subsequent recovery from 2008 to 2011, gold roughly doubled. Silver increased nearly sixfold. This isn't a flaw, it's a feature of the asset, but it's a feature you must understand and respect. The silver market is also much smaller than gold. The total above-ground investment silver is a fraction of investment gold. This means less liquidity. It means larger price swings on relatively modest capital flows. It means that when sentiment shifts, silver doesn't drift. It moves with force. Why does this matter now? Because we're entering a period where both sides of silver's nature are being activated simultaneously. Let's start with the industrial side. Global governments have committed trillions to renewable energy infrastructure. Solar panel production continues to expand. Each panel requires silver paste for conductivity. There's currently no economically viable substitute at scale. Electric vehicle production is growing, though more slowly than initially projected. EVs use significantly more silver than traditional vehicles, not just in batteries, but in electronics, charging infrastructure, and various components. The broader electronics industry, smartphones, computers, appliances, industrial equipment, continues to require silver for switches, contacts, and circuit boards. Meanwhile, supply hasn't kept pace. Major silver mines have faced declining ore grades. Many of the world's largest silver deposits are mined as byproducts of copper, lead, and zinc operations. When those primary metals underperform or face production challenges, silver supply suffers. New mine development takes years and faces increasing environmental and regulatory hurdles. The easy deposits have been found. What remains requires more capital, more time, and more risk. This creates a fundamental tension: growing demand meeting constrained supply. Does this guarantee higher prices? No, markets can remain inefficient far longer than seems logical. But it establishes a foundation, a baseline pressure that, over time, tends to resolve in one direction. The industrial story alone wouldn't be enough to create a major move in silver. After all, we've had supply deficits before without explosive price action. But combined with what's happening on the monetary side, the picture becomes more compelling. Now let's talk about the other half of silver's identity: its role as money, as a store of value, as financial insurance. Since 2020, central banks globally have expanded their balance sheets by unprecedented amounts. Interest rates were held near zero for years, then raised rapidly, and now are being adjusted again as economic conditions shift. Government debt levels in developed nations have reached peacetime records. The United States, Europe, Japan, all carrying debt to GDP ratios that would have been considered catastrophic a generation ago. Currency debasement isn't a conspiracy theory. It's official policy, stated openly by central banks as quantitative easing and accommodative monetary policy. When money supply grows faster than productive economic output, each unit of currency purchases less. This isn't political, it's arithmetic. Historically, this environment has driven investors toward hard assets, things that cannot be printed, that have intrinsic value, that exist in finite quantities. Gold has been the primary beneficiary. Central banks have been net buyers for years. Investment demand has remained robust. Gold has made new all-time highs. Silver, despite its monetary history stretching back millennia, has lagged. It hasn't made a new inflation-adjusted high since 1980. It hasn't even matched its nominal 2011 peak. Why? Several reasons. First, modern investors view gold as the premier monetary metal. Silver is seen as gold's smaller, more volatile cousin. When people seek monetary protection, they default to gold. Second, silver fell out of monetary circulation decades ago. Most people, under 50, have never used silver coins as actual currency. The monetary connection has weakened in collective memory. Third, the investment infrastructure for silver, while improved, still lags gold. Storage is more expensive per dollar value. Premiums on physical products can be higher. Transaction costs matter. But here's what's changing. Awareness is returning. As gold has moved higher, investors are beginning to look at silver's relative value. As concerns about currency debasement persist, the search for alternatives expands beyond just gold. As younger investors enter the market with fresh perspectives, silver's dual utility becomes attractive. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged around 60 to 1. It's spiked as high as 120 to 1 during moments of extreme stress. It's compressed to 30 to 1 during silver rallies. Currently, it sits well above historical averages, not at extremes, but elevated. This suggests silver remains relatively undervalued compared to gold. Does mean reversion always happen? No, but it happens often enough that ignoring it would be foolish. Understanding the fundamentals is necessary, but it's not sufficient, because markets aren't driven purely by supply and demand. They're driven by human beings with emotions, biases, and predictable patterns of behavior. Let me walk you through the typical psychology of a precious metals bull market. Stage 1, disbelief. Prices begin to rise, but most investors ignore it. It's just noise, it won't last. I missed it anyway. This stage can persist for months or even years. Stage 2, awareness. Prices continue higher, media coverage increases, more investors notice, but most still sit on the sidelines. Maybe I should buy some, but I'll wait for a pullback. Stage 3, acceptance. The trend becomes undeniable. Investors who resisted begin to accumulate. Premiums on physical products rise, shortages appear, sentiment shifts from skepticism to cautious optimism. Stage 4, enthusiasm. Everyone is talking about it. Prices are rising sharply, new investors pile in, afraid of missing out, premiums explode, dealers struggle to keep inventory, stories of overnight wealth circulate. Stage 5, euphoria. This is the end. Rational analysis disappears. Price targets become absurd. Everyone is an expert. Those who were skeptical are now the most bullish. The crowd believes prices can only go up. Then comes the collapse. Fast, brutal, unforgiving. Those who bought at euphoria panic and sell at the bottom. Those who held through volatility question their sanity. The cycle resets, often taking years before the next move begins. Where is silver now in this cycle? Somewhere between stage 1 and stage 2. Prices have moved modestly higher from recent lows. Some investors are paying attention, but there's no mania, no widespread euphoria. Premiums are reasonable. Physical availability is normal. This is good news if you're thinking strategically. The dangerous time to buy assets is when everyone agrees they're going higher. The opportune time is when interest is muted, when most people have moved on to other things, when patience is required. Silver demands patience. It rewards those who think in years, not weeks. It punishes those who expect linear progress or quick profits. Now let's get practical. If you already own silver, you're facing a specific set of questions. Should you hold? Should you add? Should you take profits? Should you rebalance? The answer depends on your situation, but here are the principles that should guide you. First, remember why you bought silver in the first place. If you bought it as insurance against currency debasement, as a store of value, as portfolio diversification, then modest price movements shouldn't change your thesis. The fundamental reasons likely remain valid. Your time horizon should be measured in years, not months. If you bought silver hoping for quick gains, you may need to reassess your expectations. Silver can deliver explosive returns, but timing those moves is nearly impossible. Impatience is your enemy. Second, avoid emotional decision making. When silver rises, you'll feel smart. You'll be tempted to buy more at higher prices, to go all in, to leverage your position. Resist this impulse. The best time to accumulate was when prices were lower and sentiment was negative. Chasing momentum is how investors destroy wealth. When silver falls, you'll feel foolish. You'll question your decision. You'll be tempted to sell to stop the bleeding. This is usually the worst possible time to exit. Volatility is the price you pay for silver's potential. If you can't tolerate drawdowns of 20 or 30%, you shouldn't own silver. Third, maintain position sizing discipline. Precious metals, including silver, should represent a minority allocation in most portfolios. 5 to 15% is reasonable for those with conviction and risk tolerance. Going beyond 20% concentrates risk significantly. If silver has appreciated and now represents a much larger portion of your portfolio, consider rebalancing. Taking some profits isn't bearish, it's prudent risk management. Fourth, think about your physical versus paper exposure. Physical silver provides true ownership and eliminates counterparty risk, but it requires storage and security. Paper silver, ETFs, mining stocks, futures, offers liquidity and convenience, but introduces different risks. Most serious silver investors maintain both. Physical holdings as core, long-term insurance, paper positions for tactical flexibility. If you don't yet own silver but you're considering it, you face different questions. Is now the right time? How much should you allocate? What form should you buy? How should you think about timing? Let's address each. Is now the right time? The honest answer is, there's never a perfect time. If you wait for absolute certainty, you'll never act. If you jump in impulsively, you'll likely regret it. The solution is to scale in gradually. Dollar cost averaging, making regular, smaller purchases over time, removes the pressure of timing the perfect entry. You'll buy some at higher prices and some at lower prices. Over time, you'll average out volatility and build a position without the stress of trying to catch the exact bottom. How much should you allocate? Start conservatively. If you're new to precious metals, 5% of your investable assets is a reasonable beginning point. You can always add more later. You cannot easily undo the emotional damage of overcommitting and then panicking during volatility. What form should you buy? For most investors, a combination works best. Physical coins or bars, recognizable liquid products from reputable mints, provide tangible ownership. An ETF like SLV or PSLV offers convenience and lower transaction costs for larger positions. Silver mining stocks provide leverage to silver prices, but add company-specific risk. Avoid exotic products, rare coins with high premiums, or complex derivatives unless you truly understand them. Simplicity is your friend. How should you think about timing? Once you've decided to allocate to silver, don't overthink short-term movements. Yes, you might buy before a pullback. Yes, you might miss a slight dip by acting today. But if your thesis is correct and your time horizon is long, these minor differences won't matter. The investors who succeed with silver are those who build positions during quiet periods, hold through volatility, and maintain emotional discipline. They're not traders. They're strategic accumulators. One final point. Only invest capital you won't need in the near term. Silver can remain flat or decline for extended periods. If you might need to liquidate in 6 months or a year, silver is not appropriate. This is capital you can afford to set aside for 3 to 5 years or longer. Now let me be direct about the mistakes that destroy wealth in silver investing. Mistake 1, trading silver based on short-term price movements. Silver is not a trading vehicle for most investors. The volatility will whipsaw you. Transaction costs will erode returns. Emotional decisions will compound. If you own silver, own it for strategic reasons with a long-term horizon. Mistake 2, using leverage or margin. When silver moves, it moves violently. Leverage amplifies both gains and losses. The investors who get destroyed in precious metals are almost always those who borrowed money or used margin to amplify their positions. When inevitable pullbacks occur, they're forced to liquidate at the worst possible moment. Don't use borrowed money to buy silver, ever. Mistake 3, putting all your eggs in one basket. Silver should be one component of a diversified portfolio. If silver represents your entire net worth, you're not investing, you're gambling. No matter how compelling the thesis, concentration risk can devastate your financial security. Mistake 4, chasing after big moves have already occurred. The time to buy is when no one cares, when sentiment is negative, when prices have been flat or declining. By the time everyone is talking about silver, by the time premiums are sky high and dealers are sold out, you're late. If you're just hearing about silver now for the first time, proceed cautiously and scale in slowly. Mistake 5, ignoring taxes and transaction costs. Physical silver incurs premiums when you buy and spreads when you sell. Depending on your jurisdiction, precious metals may be taxed as collectibles at higher rates. These costs are real and they matter. Factor them into your calculations. Mistake 6, failing to secure physical holdings properly. If you own physical silver, store it responsibly. Home safes, bank safety deposit boxes, or professional vault storage, choose what fits your situation. But don't leave significant holdings in obvious locations or tell everyone you know about them. Mistake 7, letting emotions override strategy. Fear and greed are the enemies of good investing. Silver will test your discipline, it will rise when you least expect it, and fall when you're most confident. Create a plan before you invest, write it down, and follow it regardless of how you feel in the moment. Silver is not a guaranteed path to wealth. It's not a shortcut. It's not a substitute for hard work, career advancement, or building valuable skills. But it is a tool for preserving purchasing power, a tool for diversifying risk, a tool for positioning yourself intelligently in an environment of currency, debasement, and economic uncertainty. The investors who succeed with silver share common traits. They think in years, not days. They maintain emotional discipline through volatility. They size positions appropriately. They don't overtrade or use leverage. They understand both the opportunities and the risks. Right now, in early 2026, silver sits in that uncomfortable middle ground where it's not cheap enough to be obviously compelling and not expensive enough to create excitement. This is often when the best opportunities exist, when patience is required and attention is elsewhere. Whether you're holding silver or considering it, the path forward is the same. Clarity about your goals, discipline and execution, and patience to let the thesis unfold. The future is uncertain. Silver won't eliminate that uncertainty. But approached intelligently, it can be one part of a resilient financial strategy. A strategy built not on hope or hype, but on sound reasoning and realistic expectations. The choice, as always, is yours. Make it wisely.